Well, beyond the struggling markets, we are also seeing real increases in auto and mortgage delinquencies. Are these fresh worrying signs that the consumer slowdown is picking up steam? Let's welcome to the set Michelle Meyer, Mastercard Economics Institute's chief economist. Michelle, welcome. Great to see you in person here.
Great to be here. Thanks for having me.
So we're hearing so much, the sentiment data is softening, and we're hearing, grousing from the C-suite about tariffs and the impact on consumers, et cetera. Are you seeing that in the data?
So you're not yet. And I think that makes sense because the first to react to headlines are going to be the soft data. It's the surveys, which is showing up. The University of Michigan Consumer Sentiment Survey showed an increase in inflation expectations, even longer run inflation expectations, which is meaningful. So consumers are thinking about what tariffs might mean for the future and how persistent it might be for how they absorb prices. But they're not spending very differently yet, at least not in a discernible way. And I think a lot of that is because the fundamentals of the economy are still sound at the moment. When you think about the labor market, when you think about wage creation, when you think about the fact that there's been a very positive wealth effect over the last few years, and a lot of that has buoyed the consumer.
How do you think about how the consumer will spend once the tariffs go into effect in terms of a shift maybe towards grocery and away from discretionary? I don't know if you use 2018 as a guide here at all.
Yeah, well, I think what we've learned about the consumer in the last few years is that the consumer's been very nimble, right? This is a consumer who is very aware of where they can find value and how they want to deploy their purchasing power so that they get the best out of their dollars. So you could imagine an environment where the categories that have seen the biggest price increases because of that pass-through of tariffs, maybe they shy away from purchasing those and move towards those that have more value, lower prices. You don't see the tariff impacts. You could see a little bit of a goods experience story play out where the services economy that doesn't have the direct hit from tariffs, experiences like travel, restaurants, leisure, maybe there's some acceleration in spending there, where some of the durable goods, where the tariff impact could be more meaningful and quick, consumers shy away. We'll see. We'll see how the consumer responds.
So as a sort of segue from consumer spending to worrying if the consumer is really starting to get hurt, what's the most important piece of data that you look at, whether it's 30-day delinquencies or something totally different, that is a good sort of indicator of, wow, the consumers really feeling pinched and we got maybe a credit issue here?
So there's the balance sheet issue, which you're speaking of, but then there's also the drivers of spending, which is the labor market. And to me, both of those matter, but I like to really focus on the labor market as an indicator of what's to come for the consumer. And I think that was really important in the last several years when people have been looking for this big turn in the consumer. It's coming, it's coming. How can the consumer continue to spend? Well, they can spend because the labor market is supportive. So tomorrow's jobs report will be very important. It's still early in the process, right, in the sense that we're probably not going to see if these headlines are mattering just yet, but monitoring all the different labor market measures, initial jobless claims, the JOLT survey, the Challenger survey, and, of course, that monthly jobs report.
Is there an unemployment rate where things start to flash? And, because, listen, it's historic in terms of how well the job market's been, but you know quickly how things can change. So speak to the level that gets concerning.
So I think it's less about the level, and it's, as you said, the change. It's the rate of change. Once you see the unemployment rate trend higher and it's consistent and it's indicative of people losing their job and staying out of work. So looking at things like how long or the duration of unemployment, the micro data within the jobs report, then you start to worry because then you realize that there's not that degree of healthy churn in the workforce that would be supportive of the consumer going forward. But we're not seeing that, right? You have a 4% unemployment rate. That is a low unemployment rate.